Hey everyone, I want to talk to you today about something that's been generating a lot of discussion in our community. The industrial revenue bond that Woodford County Fiscal Court is considering for Castle and Key Distillery. There's been some information circulating on social media that I think deserves a clear, honest, and thorough response. I've spent most of this past week building a detailed analysis using real numbers I've requested and received permission to share with you publicly for the first time. I also want to address two specific provisions in the bond documents that I think are important and that have not been part of the public conversation yet. Let's start at the beginning. What exactly is an industrial revenue bond, an IRB? An IRB is not a grant, it is not a gift, it is not a check the county writes to a company. An industrial revenue bond is a financing mechanism authorized under Kentucky law that allows a county or city to hold title to a project's real property and equipment during the term of the bond. In exchange, the company leases that property back and makes payments on the bond. Because the county technically holds title during that period, the property qualifies for a property tax abatement. That's it. No cash changes hands from the county to the company. The county takes on no debt. The county's credit is not pledged. The county's constitutional borrowing capacity is not affected. The bonds are backed solely by Castle and Key's own lease payments, not by you, the taxpayers. Now, and this is the single most important clarification I can offer. When you see the number $90 million associated with this IRB, that is not a $90 million tax break. That is not a $90 million gift from Woodford County. That $90 million is the ceiling on the capital investment Castle and Key intends to make in our community, in buildings, renovations, capital projects, over the life of this bond. That includes a responsible cushion for cost overruns and inflation over a 40-year period. It is their money being invested here. This type of financing is common across Kentucky. Here, recently, they've been used for Woodford Reserve, and the city of Midway has used them with Lakeshore Learning. And dozens of other companies across Kentucky have used IRBs for exactly this purpose under the same state law. So what does this IRB actually cost local taxing districts? I've spent this past week building a detailed cost-benefit analysis using Castle and Key's actual 2025 figures. I requested and received permission to share these numbers, which were provided to us labeled privileged and confidential. What has made this conversation especially difficult is that some information being shared was misleading, unintentionally or otherwise, falsely suggesting this is a $90 million tax break or expense to the county. It is not. Now I can share something more accurate. Here are the real numbers. The total annual local property taxes that would be abated on the real estate included in this bond total approximately $123,046 per year. That is the gross cost. The breakdown by taxing districts is, first, our school district, $92,757. But I'll come back to this. Our library, $7,379. Fire district, $6,098. The county, $8,646. The health department, $2,951. The extension district, $2,345. The city of Versailles, $2,870. Now, here's what Castle and Key pays in taxes that are completely unaffected by this IRB. Their distilled spirits tax, also known as the barrel tax, on aging whiskey generated $726,675 in 2025 alone. Not $1 of that is abated by this bond. Their occupational taxes, wages, and net profits generated approximately $69,153 in 2025, also completely unaffected. So in a single year, Woodford County and its taxing districts received just shy of $800,000 in revenue from Castle and Key that this IRB does not touch. That gives us what I call a revenue substitution ratio of approximately 6.5 to 1 on a gross basis. For every dollar of property tax we forgo, we retain more than $6.5 in other revenues from this same business. The minimum threshold for sound public policy on IRBs might be considered 1 to 1. We were at 6.5 to 1 before accounting for the pilot agreement. And that's the next thing I need to explain. The pilot agreement, the payment in lieu of taxes agreement, is something I would insist on as a condition of my support. But I want to explain specifically how it works, because the mechanics matter. The school district is the single largest recipient of local property taxes. They levy no occupational taxes. They collect no net profits taxes. Their primary local revenue source is property taxes, and that makes them uniquely dependent on protections in an arrangement like this. Here's how the pilot works. Under the agreement, Castle and Key will pay 22% of the abated school property tax. That's approximately $20,407 per year, directly to Woodford County Schools. They rate that check straight to the school district. The remaining 78%, approximately $72,350 per year, is covered automatically through the Kentucky's SEEK school formula. When property is removed from a school district's tax roll, the state's school funding formula recognizes that reduction and increases state funding to that district to compensate. So the school district gets the money from the state rather than from Castle and Key. Add those two streams together, $20,407 from Castle and Key plus $72,350 from the increased SEEK state funding equals $92,757, which is exactly 100% of the abated school property taxes. The school district loses nothing. That is what held harmless means in practice. It is in the agreement. It is not a hope or a promise. It is a contractual obligation. When you take the school district out of the abated total, because they are fully protected, the net truly abated amount after the pilot is approximately $30,289 per year. At that net figure, our revenue substitution ratio becomes 26 to 1. And the payback period, the number of days of retained revenue needed to cover the full year's net foregone taxes, is 14 days. Let me walk you through the 5 metrics I've considered to evaluate whether an IRB represents sound public policy, because I think we need a serious, quantifiable framework for these decisions, not just impressions. First, the revenue substitution ratio. Retained revenues divided by net abated taxes after the pilot agreement. Our figure is 26 to 1. The minimum threshold for sound public policy is 1 to 1. The threshold for strong justification is 2 to 1. Again, we are at 26 to 1. Second, net present value of fiscal impact. The present value of all retained revenues over the entire bond term, minus the present value of all foregone taxes foregone, accounting for the time value of money. Even modeling the distilled spirits barrel tax declining to 0 by 2043, this number is strongly positive across every scenario I ran. Third, the annual abated cost per job. How much local tax abatement are we offering per job supported? At $30,289 in annual net abated taxes divided by 100 existing jobs, that's approximately $303 per job per year. That's the standard threshold for sound retention incentives is under $5,000 per job. We're at 303. Third, annual abated cost per job. How much local tax abatement are we offering per job supported? At $30,289 in net annual abated taxes divided by 100 existing jobs, that's approximately $303 per job per year. The standard threshold for sound retention incentives is under $5,000 per job. We're at 303. Fourth, cost-benefit ratio, the academic standard used in peer economic development research. It accounts for multiplier effects, the indirect economic activity that flows from employment, capital investment, and tourism. Our estimated ratio is well above 26 to 1. Fifth, Payback period. How many days of retained revenue does it take to cover one full year of foregone taxes? 14 days. The full year's net foregone property taxes are covered before the middle of January. Castle and Key clears every one of these metrics at an exceptional level by a factor of many times the minimum threshold. And that's on the most conservative possible assumptions before a single new job is created. I want to highlight a provision in the bond ordinance that has been added in the most recent draft and that addresses a concern some people have raised about the 40-year commitment, also a concern I share. The bond ordinance now includes an early termination right for the county. The ordinance provides that the county may elect to terminate the bond on or after year 20. In plain terms, if the fiscal court 20 years from now decides this arrangement is no longer serving the community's best interests, they have a structured, legally established path to exit. This was not in prior versions of the ordinance. It is in the version before us now. Let me be clear about what this is. It's an option, not an obligation. If the project is delivering, if jobs are being retained and created, if the investment is materializing, if the community is benefiting, there would be no reason to exercise it, but it is there. The county is not locked in for 40 years without recourse. Now here is where the timing gets interesting. The 20-year exit point would land around 2046. By that time, the distilled spirits tax will already have been zero for 3 years. It phases completely to zero under HB 5 on January 1st, 2043, which is year 17 of this bond. So when the fiscal court of 2046 evaluates whether to exercise the exit right, they will essentially be asking one clean question. Do the occupational taxes from Castle and Key's workforce still justify the property tax abatement? And the math at that decision point is still pretty compelling. By year 20, Castle and Key's occupational taxes, growing at even a modest 3-year percent annually, will be approximately $125,000 per year. Again, if the annual net abatement cost remains at $30,000, that gives an occupational tax only revenue substitution ratio of approximately 4-1 at the exit decision point. The payback period on occupational tax alone will be less than 90 days. So we have a genuine off-ramp if we need it, and the numbers suggest there will be a strong case to continue even after the barrel tax is fully gone. Now I want to talk about the phase out of the distilled spirits tax or barrel tax in more depth and why protecting our schools and fire district through that transition was so important to me personally. The Kentucky General Assembly passed House Bill 5 in 2023, which phases out the barrel tax entirely again by January 1st, 2043. I want to be direct. I went to Frankfort and I vehemently oppose that repeal. I believe then, and I believe now, that the barrel tax was an important source of revenues for our local taxing districts. The repeal passed anyways, and I was working hard to make sure that we protect our most vulnerable districts. Thanks to advocacy during the legislative session, we secured replacement tax provisions under Kentucky law that guarantee our school district and our fire district continue to receive revenue equivalent to what they would have received from the barrel tax, even as it phases down to zero. Other taxing districts do not have that protection, but our schools and fire district do. If we had an EMS district, it would also be protected. The replacement tax works differently for each. For schools, it is specifically calculated to account for the SEEK state funding formula, the same mechanism I described in the pilot section. So schools are not doubly compensated, but they are fully protected. For the fire district, it is a direct replacement of the distilled spirits tax revenue they lose as the phase-out proceeds. And I want to add, there is a separate fee arrangement being worked out directly between Castle and Key and the fire district. I haven't been able to review all those details yet, but when it's finalized, I'll be transparent about what it means for the fire district's fiscal picture, and it is not yet reflected in the numbers I've shared today. I want to be transparent about why I view this IRB differently from the industrial revenue bonds previously issued for Brown-Forman and Woodford Reserve, and why that history genuinely informs my thinking. Those bonds were structured to include barrel warehouse facilities. At the time, the selling point was that following the bond term, the distilled spirits tax or barrel taxes on those barrels would flow to local taxing districts as significant long-term revenue. That was a justification, and we took it seriously. But here's what happened. Those bonds haven't expired yet, and the barrel tax is already being phased out. The revenue that was supposed to materialize at the end of the bond term will not arrive because the tax itself will be gone before the bonds mature. That is a disappointing outcome. And when I asked at the time about the potential for barrel tax repeal, I was told it wasn't going to happen. Repeal legislation passed a couple months later. I went to Frankfurt and I vigorously opposed it. That experience is precisely why I'll more than likely not support any future IRBs for barrel-only warehouse projects in this county. Barrel warehouses do not create jobs. They generate no occupational tax revenue. And now, with the barrel tax phasing out, they produce no long-term revenue benefit at all. This Castle and Key project is different in every meaningful way. It is an operating distillery with real employees. It involves tourism, it involves capital investment in buildings and facilities, it involves overnight accommodations, and the barrel tax, while it lasts, is retained in full. One revenue stream I want to specifically highlight that hasn't been part of the public conversation is the transient room tax. The projects outlined in the IRB documents include potential overnight accommodations, the conversion of an administration building into a guest lodging facility, and a renovated superintendent's cottage with an overnight rental option. These are new hospitality facilities that would generate transient room tax revenue for the county's Tourism Commission every time a room is booked. Castle and Key attracted over 25,000 visitors in 2025, with guests coming from all 50 states and multiple countries. Adding overnight accommodations doesn't just generate transient room tax revenue, it lengthens stays, increases spending at local restaurants and businesses, and amplifies the economic multiplier effect throughout our community. That upside is not in any of the figures I've shared today. It only makes the case stronger. On jobs, I genuinely appreciate Castle and Key's conservative approach. They have not overpromised. They have not handed us inflated job projections designed to win political favor. That honesty is refreshing, and I respect that. What I can say with confidence is this: if you operate a hotel, you need hotel staff. If you operate a full-service dining facility, you need kitchen and front-of-house staff. If you expand a single-barrel selection tasting room, you need hospitality staff. The exact number, I won't speculate, but the direction is clear. Each additional employee at an average wage of $41,102, that's derived from Castle and Key's occupational tax figures, generates approximately $617 per year in occupational tax revenue. That is before any tourism multiplier effects, before any spending in our local economy, before any transient room taxes. The industry is also facing real headwinds, driven significantly by retaliatory tariffs on American bourbon and key international markets. In some cases, bourbon being pulled from shelves entirely. Castle and Key is asking for this economic incentive to help them maintain their footing and make this investment in our community with greater confidence. That context matters. Some have suggested we have moved too hastily, pointing to the first reading as evidence of rushing. I understand that concern and I respect it, but I want to gently push back. We are finishing our second week of this discussion in committee, in the fiscal court, and in the community. That is not hasty, that is deliberate. But I also want to be clear. We do not have to have a vote for a second reading at our next meeting. If members of the fiscal court or members of this community do not feel they have received sufficient answers to their questions, I would not support a second reading of the ordinance. I mean that sincerely. That said, productive public policy requires two-way communication. I've asked questions of our staff, their attorney, and their team throughout this process, and I've done so before our public meetings, not as a performance during them. I believe the public deserves to hear honest answers to honest questions. That is a different thing from waiting until a public meeting to raise procedural objections for the cameras. If you have questions, bring them to me. Bring them before the meeting. Let's have a real conversation that moves our community forward rather than one designed to generate conflict. Look, this is a significant decision. The numbers support it, clearly and by wide margins. The school district is fully protected contractually through the pilot agreement. The fire district has both statutory replacement tax protection and a separate fee arrangement in progress. The community investment is real. The net annual cost to local taxing districts after accounting for the school pilot agreement is approximately $30,289 per year against $796,000 in retained revenues. The county has a genuine exit option at year 20 if circumstances change. But beyond the numbers, what I care most about is that we have serious, informed, good faith conversations about our community's future, not misinformation, not conflict for its own sake, not political theater. We live in a remarkable county. Castle and Key is a remarkable asset, and our community deserves leadership that treats decisions like this with the seriousness and the honesty they require. I'll continue to share information as I'm able. I'm available for questions, and I'm committed to getting this right. For our schools, for our taxing districts, for our workers, and for Woodford County. Thank you.